I'm going to show you exactly when to trade and when to avoid the markets. GM friends, this is Sloan Academy. Without wasting much time, let's get right into it. So yeah, if you've been following my videos, you will see that I've been teaching some strategic SMC concepts, talking about market structure, breaker blocks, reclaimed order blocks, and other concepts. But one thing that has been lacking is the market inefficiency and efficiency class. Alright, so this is a little secret that I'm going to be teaching you. When you calmly learn and implement this strategy, it's going to change the whole game for you. So grab a notepad and a pen and sit tight. Alright, so before we get down into it, hit the like button, hit the subscribe button, and leave a comment. And then in the course of this video, you will learn strategic things and points that you need to change your trading game. Okay, so yeah, let's get on into it now. Our topic for today is EPA and IPA, basically efficient price action and inefficient price action. Okay, so what is efficient price action? Efficient price action now refers to the smooth balanced price movement where the market moves in a controlled manner, often with small retracements. All right, understand this now. We are going to be giving graphical examples of the charts of how efficient price action plays out and inefficient price action also plays out. All right, so efficient price action now are of two types. We have the type 1 and the type 2 efficient price action. Okay, so before we get right back into it now, there are rules that we must abide with while trading to see if the market is efficient or inefficient. Okay, so these rules are three. Actually, these are the three rules I follow. The first is price will always seek to balance an inefficient price action. The second is no efficient price action, no trade. And then the third is price will readily trade from an efficient price action. Alright, so having known these three rules now, it's easier that we'll get back into the charts now and using the textbook diagram explain what we mean by type 1 and type 2 efficient price action. Alright, so what is the type 1 efficient price action now? No, type 1 efficient price action is when the market comes back to retrace into the demand block to mitigate before taking off. Alright, so we have, for example, this setup in an efficient price now. If you remember correctly, we discussed some time ago about demand zones and demand blocks. All right, and from what we said the last time, we said that this area is a whole demand zone. All right, and then meet in between it now you can find demand blocks within them. Okay, so this is basically type 1 efficient price action now. When there is a move, an uptrend move, and then a demand zone is left below, and then you see the market retracing back into this demand block to mitigate the block, and then it keeps going. All right, so that is from this area right here down is the whole demand zone for this particular move. All right, and as you can see, the market clearly came down, mitigating that demand zone right here. Mitigating the demand zone right here. All right, so and secondly is when there is liquidity, price will always look to take off inducement and then buy. Okay, so in a scenario now where we have a move like this, and market leaves a little inducement right here and then breaks structure, markets will definitely come to take off liquidity from that inducement, then balancing this price from this point, and then you can now see a bounce off. So if you look correctly at this chart now, you will see that the price is efficient. Okay, there is no imbalances, there is no massive or long candles that left favorable gaps or any form of inefficiency in the market, but the market came back to daily mitigate these other blocks before proceeding off. Okay, so now we will now be going into the EPA type 2. Okay, so this is basically our EPA type 1, and our EPA type 2 is when the market now does a move like this. Okay, it is exactly when price retraces back into the demand zone but it might not necessarily get down to the demand block before it takes off. Okay, because if you notice, if you remember correctly now, from what we say from here now, the market bounces up and then comes back to the demand zone and the block and mitigates the two and then keeps going. But in EPA type 2 now, the market doesn't necessarily need to come down to the demand block. It just taps into the demand zone and then it moves. Alright, so a typical example is this. I have an uptrend, for example, and then there is a move up. Then you see the market coming back into this zone now. You remember we said from the point where the market was broken down to the low is the demand zone. So market automatically comes back into this point now. It's getting the demand zone and then continuing in its move. And then the next thing you will see is a mitigation of this low now and then continuation. So basically here, this is an efficient price. Market mitigated the zone. So the zone is efficient, but then below it is a block that is not yet mitigated. Okay, so there is also a possibility that furthermore in the future the market can decide to come back and tap into that block, mitigates it, and it keeps going further. All right, so the market in future times, I've already said it already, might come back to mitigate the block and then keeps going. Okay, so secondly, okay, so basically now we've discussed type 1 and type 2 efficient price action. Okay, now we'll be looking at inefficient price action so as to understand the two sides of the coin, the second part of the inefficiency. All right, so let us clean this off and then get to inefficient price. Okay, so basically now we're about to discuss the inefficient price action. So what is inefficient price action now? Inefficient price action can also be known as impulsive moves or imbalances. Now it occurs when price rapidly moves in one direction, leaving unfilled orders and imbalances in the market. Now these areas are often revisited to mitigate the inefficiencies. That is, market also comes back to these zones of inefficiency to mitigate these markets. Okay, inefficiency, inefficient price action. Now this inefficient price action also follows the rule of when the price always seeks to balance inefficient price action, and then when there is no efficient price action there is no trade, and then the third is price readily trade from an efficient price action. All right, so graphically this is an example of inefficient price action. We have an uptrend, for example, here, and then we have the first leg, a retest, a break of structure, and then eventually this is what we see. The market comes, taps here, and keeps going. And eventually from this move now, you see the market doesn't come into the demand zone at all. It doesn't mitigate the demand zone, neither does it mitigate any block below it. So this is basically what we mean by inefficient price action now. This zone now has not been mitigated. So there is also a possibility that furthermore the market might still decide to come and mitigate that zone and then keeps going. That's why I always say that we react to what the market does. We do not predict what the market will do. Okay, so that's basically the type 1 of inefficient price action. So furthermore now, price will always try to come back to the imbalance zone, rebalance it and makes it efficient again and takes off. Practically what I just showed us previously. So what can we do if we have an inefficient price? What can we do if we have an efficient price after an inefficient price action? All right, so practically now, what can we do when we have an inefficient price here and then market comes back, makes this point efficient and then keeps going and keeps creating efficiencies in this chart? Okay, so in a case when there is a balanced price, in a case when there is a balanced price action above an imbalanced price, then what we need to do now is to look for continuations of our trades from the efficient price, because price you readily trade from the efficient price action up until later when the market comes back to balance the market. All right, so basically this is what I'm saying here. When an inefficiency has been left and the market creates a high and then starts filling up these efficiencies at this point, we'll now keep taking our trades right from those inefficiencies, neglecting the inefficient price action that has been created so far, up until the market decides to come back down into that zone to mitigate it and then keeps going. All right, so that's basically what we mean by efficient and inefficient price action. Now, the efficient price actions work well with key levels. I keep saying this, I said it in the previous video on entry models. Key levels, 4 hour time frame POIs are very important in order to take efficient trades. Okay, so these efficient price actions work very well with key levels. Okay, so you can see that this video is pretty detailed, and if I'm really going to continue, I might want to stop here, because if I continue, this video will get too long and start getting very boring looking at the screen. So I'm going to cut this video shortly here and do a part 2, a subsequent follow-up video explaining the chart examples of these efficient and inefficient price actions that we just discussed. So if you did enjoy these insights, which I recommend you backtest, smash the like button and subscribe, and I hope you really enjoy this. I'll see you in the next video.